Well, good afternoon, everybody. It's a pleasure to be here in northern New Jersey to address the 8th County Morris County Economic Development Corporation's Business Growth Forum. This is an annual event organized by the Morris County Chamber of Commerce, so it's great to be here. It's always a pleasure to speak to the business community, and I thank you for having me here today. You know, I get out of my office in New York pretty regularly to inform myself firsthand about economic conditions and challenges in the 2nd Federal Reserve District. Each visit within the region helps me to strengthen my relationships with the people of this district and build a deeper understanding of the economic challenges that we face. Today I want to talk a little bit about the Federal Reserve, what we do and why we do it, and then I'll provide some thoughts about the national and local economic outlook. Normally in these regional outreach speeches, I say very little about monetary policy, but since we did make some meaningful decisions last week, you call it QE3, we call it large-scale asset purchases, but it's the same thing. And it is important for people to understand, I think, the reasons and motivations for our actions. So I will conclude with a brief discussion of monetary policy. After that, I'll be happy to take your questions about, any questions you have about what the Fed does, why we do it, and about the economic outlook. As always, what I have to say reflects my own views and not necessarily those of the Federal Reserve System or the Federal Open Market Committee, which is also known as the FOMC. So by way of introduction, let me start by briefly reviewing what my colleagues and I do at the New York Fed. The New York Fed is one of the 12 regional Federal Reserve banks that, together with the Board of Governors in Washington, D.C., makes up the Federal Reserve System, so that's our nation's central bank. The Federal Reserve is independent within government. By law, we're charged with managing the nation's monetary policy, taking actions that raise or lower interest rates to promote our dual mandate, full employment, and price stability. We're also charged with promoting financial stability, because without financial stability, we cannot achieve our other economic objectives. We also play an important role in the nation's payment and settlement systems, which you might think of as the plumbing of the financial system. And we do have a specific mandate to promote economic development in each of our regions. As president of the New York Fed, as you heard, I serve as the vice chairman of the Federal Open Market Committee. That's the committee that meets 8 times a year in Washington to set interest rates and make other decisions about monetary policy, and we had a meeting last week. Now, the members of this committee all strive to achieve that dual mandate, maximum employment and price stability, but sometimes we have different views about the specific policy choices at hand, and you should view that as completely appropriate. These are hard questions, especially during the difficult economic circumstances in which we find ourselves today. In fact, I think we make better decisions as a committee because we don't all think alike, but we are united. I can reassure you, we are united in our commitment to our dual mandate of maximum sustainable employment and price stability, and in our belief that preserving the independence of the Federal Reserve in making monetary policy decisions is very much in the public interest. That independence allows us to make tough decisions based on data and analysis, insulated from short-term political pressures. Now, at the FOMC meetings, each committee member presents their current outlook for the region and for the nation. And in formulating these assessments, we do consult with lots of different sources, our boards of directors, regional advisory councils, committee leaders, and other key stakeholders. And my meeting with you today and with others that I'm going to meet with today on this trip through northern New Jersey is part of that effort to understand what's going on in the grassroots of our economy. To help gather more information about the region, we met this morning with Fox Valve, which is a small business in Dover that manufactures highly specialized engineered industrial parts. After that, I had the pleasure of participating in a roundtable with members of the local Mexican-American business community. So after this lunch, we're going to Picatinny Arsenal to learn about its role in the state's economic activity. And I'll also be meeting with leaders of the New Jersey Community Capital to learn about cutting-edge programs for helping distressed homeowners. And then my day concludes by going to Montclair State University, where I'll speak to the students, faculty, and alumni. In addition to these outreach efforts, my colleagues and I at the New York Fed continually track conditions in our district And we've created a number of tools just for that purpose. For example, we produce indices of economic activity for New York City, New York State, and New Jersey. We also track household credit conditions, including the amount of personal debt and whether payments are being made in a timely way by households. We also conduct a periodic poll about the credit needs of small businesses, which we think is an important source of new jobs in the region. In our latest poll of several hundred firms, many report that they did not apply for credit because they were, quote, discouraged. Perhaps surprising, many of these non-applicants turned out to have credit profiles similar to other firms that sought credit and successfully got it. This finding is actually a little bit encouraging because it suggests that as the discouraged workers become less discouraged and actually go out and seek credit, they actually may find that they can actually have success in obtaining credit now. So if you, as a representative of a small business, would like to participate in our next poll, and we would very much encourage you to do so, please give your card to one of my colleagues in the audience or come up to see me afterwards and give me your card, and we'll make sure that you're included in the poll because we'd love to have you as a respondent. In addition to promote economic development in our local communities, we publish a lot of data and analysis on the local economy, including the small business poll findings. In addition, we provide education outreach initiatives to help small businesses. So, for example, in October, we hosted a workshop in Newark to help local businesses learn about export credit facilities and new tools for marketing their products abroad. At the same time, in October, we're going to also announce our annual financial awareness video competition. This is aimed at helping young adults make sound personal financial decisions. Now, as you know, even states as wealthy as New Jersey have large pockets of poverty. So we also target some of our work specifically to lower and moderate income groups. We've worked hard to help neighborhoods that face high foreclosure rates. And this work is informed by an analysis that suggests that high levels of foreclosures have lots of ripple effects. They affect the value of neighboring homes, the local tax base, and economic activity more broadly. We've provided housing counselors and community development groups with the latest information on mortgage conditions via mortgage briefs, roundtables, presentations, and newsletters. In fact, we have an interactive tool on our website that shows monthly delinquency and foreclosure data at a local level. This fall, we're going to host a conference on distressed residential real estate to share what we and leading experts have learned with senior policymakers and practitioners from across the United States. So as you can see, that all in all, there's a lot to keep myself and my colleagues busy. So now let me turn to the regional economy. So how is our region doing? Let me start by saying that New Jersey is well positioned to prosper. New Jersey is the 11th largest state by population, 8.8 million people, and this population is well educated. Roughly 35% of the adults over 24 years old have a college degree, and this is well above the national average. Here in Morris County, that figure is almost 50%. The state is also quite ethnically diverse. Roughly 20% of New Jersey residents were born abroad. The state's economy is industrially diverse. It resembles the nation. New Jersey employs many people in healthcare, professional and business services, wholesale and leisure trade, leisure and hospitality. In the northern part of the state, we see a disproportionate share of the jobs in a few industries. Finance, particularly in Hudson County, goods distribution related to the ports, rail lines, and trucking, pharmaceuticals manufacturing and R&D, and private education. The area also obviously benefits from its important links to New York City. I, for example, live in New Jersey, but commute every day into the city. So how's the recovery proceeding here? Well, based on the New York Fed's indices, economic activity in the state began its recovery a little late relative to the rest of the country, not starting really until November 2010. It's about a year after the nation as a whole in New York City. Since then, activity has recovered at a moderate pace, but we're still below the prior peak. Employment in New Jersey declined substantially during the economic downturn. Our employers cut about 250,000 jobs. That represents about a 6% loss in jobs. That's about on par with the loss percentage nationally. So far, we've only recovered about 1 in 4 of the jobs that we've lost, and that's slightly weaker than the nationwide recovery. and of course much weaker than I'd like to see the case. Now, over the past year, the private sector has seen moderate job gains, led by some of the key sectors that I mentioned earlier, particularly professional and business services, education and health, and leisure and hospitality. But the state continues to shed jobs in manufacturing, and so far there's been very little recovery in construction. State and local government cut back employment substantially during 2010, though there has been a modest pickup in state and local employment over the past year. Unemployment among New Jersey residents remains high. July's reading of 9.8% puts the state's rate well above the national average. So more broadly, how are the state's families doing financially? Well, the median income among New Jersey families is the second highest in the nation, almost $70,000 per family. But despite that, roughly a tenth of the residents live in families with incomes below the poverty line. Although that rate is below the national rate of 14%, it varies considerably by county across the state. And that's particularly high in Essex, Hudson, and Passaic counties. So reducing poverty is a major challenge for policymakers in the state. New York Fed's measures of regional credit conditions suggest that there are continued financial challenges for families here. As of the second quarter of this year, for example, for people with a credit report, average debt per person in New Jersey was about $63,000. That's about the same as where it's been over the last few years. And delinquencies rates on that debt were high. 8.4% of all debt in the state is seriously delinquent. That's actually up from where it was in 2011, and it's well above the national average of 6.7%. So New Jersey households still struggling with their finances. While there are some signs that home prices in the state are starting to uptick, nevertheless, the housing crisis continues to take a considerable toll on homeowners. As of June, 9.3% of all mortgage debt in New Jersey was 90 days plus delinquents. That's 3 percentage points above the national average. And that delinquency rate is actually a little higher here in northern New Jersey compared to the state as a whole. So it's still quite a long way to go in the economic recovery in New Jersey. Now, what about national economic conditions? Well, the performance of the U.S. economy since the end of the recession in 2009 has, quite frankly, been disappointing. Real GDP has grown at just over a 2% annual rate over this period, and it was actually a little slower than that during the first half of 2012. As a result, we've seen employment gains, but those employment gains have been modest, and the unemployment rate remains above 8%. That's an unacceptably high level. And participation in the jobs market, so people who are actually looking for work, remains depressed. Moreover, we have about 5 million workers in this country that have been unemployed for 6 months or more. That's important because long-term unemployment can cause job skills to atrophy, and that will make it more difficult for such people to find jobs in the future. Now, while the good news is that the job finding rates for those long-term unemployed don't seem to have deteriorated as many had feared at this point, we can't take that for granted going forward. Now, although energy prices have begun to rise again, the total inflation, as we measured by year-over-year changes in the Consumer Price Index, is very, very subdued. The Consumer Price Index is running about 1.75% over the last year. That's about half the rate it was a year ago, in September 2011. And if we strip out food and energy prices, which economists like to do, core inflation is also very moderate, also below 2%. But I do recognize that you all have to eat and drive. Fact is, higher energy prices and grain prices means that we'll probably actually see that headline inflation rate tick up over the next few months. But then I think it will come back down as we go into 2013. Measures of the underlying inflation rate are very moderate. Wage gains remain subdued, and longer-term inflation expectations are well anchored, very consistent with our longer-term inflation objective of 2%. Near term, the economic outlook is that the growth pace is likely to remain disappointing in the near term. On the positive side, August showed a decent increase in motor vehicle sales. Nevertheless, retail sales outside of autos and gasoline were soft in August, and households continue to be cautious. One brighter spot is the housing market. Housing starts and sales of new and existing homes are starting to trend upward gradually. And nationally, home prices have stabilized and begun to rise modestly after falling by roughly 30% from their peak in 2006. Now, housing conditions are improving nationally as a whole, but they still vary significantly across the country, with the worst performing counties still experiencing significant declines of up to 8% or more. So this sector, while it's stabilizing, just getting back on its feet. So even if we start to see gains from this sector, it's not going to provide much lift to the economy because it's shrunk to a very, very small size after the downturn. In addition, despite the fact that the housing recovery is starting to recover, homeowner net worth remains far below where it was at the beginning of the housing crisis. The near-term outlook for the business sector is actually a little bit darker right now. New orders for non-defense capital goods and information on business plans for spending on new structures, both of those suggest that we're going to see weakness in business fixed investment in coming months. Also, many of the recent indicators point to sluggish manufacturing activity, including the ISM Manufacturing Composite Index, several regional manufacturing surveys, and we saw a big drop in August industrial production. Our own Empire State Manufacturing Survey, so that applies to the 2nd Federal Reserve District, fell deeply into negative territory in September. The manufacturing slowdown stems from several factors, including the slowdown in the growth pace abroad, and I think uncertainties about how the fiscal cliff in Washington will be resolved. So the question is, why has the economy grown so slowly since the official end of the Great Recession? I think there are many reasons, but I would cite 5 factors as particularly important why we're having such a slow economic recovery. The first is access to credit. Although credit availability is slowly improving, it remains impaired. And that's especially true for households with less than sterling credit histories and for some small businesses. Second, balance sheet repair. Although substantial progress has been made, many households still need to rebuild their net worth following the housing bust. More than 20% of homeowners in the country as a whole with a mortgage are underwater, meaning their homes are worth less than the value of their mortgages. The third problem is fiscal drag. State and local governments have been cutting spending for over 2.5 years, and federal government spending is also contracting. While fiscal consolidation, of course, is essential over the medium to longer term, those spending cuts do reduce demand and are a drag on near-term growth. Fourth problem, risk relating to Europe. The crisis in the euro area has pushed Europe into a recession, and that's reduced the demand for U.S. exports, and that's also weighed on U.S. financial markets. And fifth, something I've already mentioned, fiscal uncertainty at home. Families and firms faced elevated uncertainty related to what's going to happen to their taxes and what's going to happen to government spending in the future. In particular, what's going to happen when we get to this so-called fiscal cliff. The prospect is that there's possibility of sharp increases in taxes and cuts in spending at the beginning of 2013 if Congress and the White House cannot agree to an alternative fiscal plan. So even if it's resolved in a good way, that uncertainty today affects people's willingness to spend. Now, given the signs of improvement in some of these areas, including the slow but steady process in healing balance sheets and restoring the supply of credit, I think that the most likely outcome is that the pace of economic growth will gradually pick up in 2013, 2014, supported by very low interest rates. But heading into the FOMC meeting last week, I judged that if we did not ease monetary policy further, the pace of improvement would be unacceptably slow. So let me talk a little bit about monetary policy. Last week, the FOMC took additional action to promote a more robust recovery in the context of price stability. In order to ease policy, the FOMC deployed 2 complementary tools: asset purchases and forward guidance on interest rates. With respect to asset purchases, or what people in the common refer to as QE3, the committee said that it would start buying additional mortgage-backed securities at a rate of $40 billion per month. In terms of rate guidance, the committee said that it anticipated that exceptionally low levels for the federal funds rate would be warranted for, quote, at least through mid-2015. Now, as Chairman Bernanke explained in the press conference that followed the meeting, the committee also took 2 other steps to underscore its commitment to ongoing support of the economic recovery. First, the committee said that it did not see substantial improvement. If it did not see substantial improvement in the outlook for the labor market, it would continue the MBS purchase program, undertake additional asset purchases, and employ its other policy tools as appropriate until it does. Second, the committee emphasized that it expects that a highly accommodative stance of monetary policy will remain appropriate for a considerable time after the economic recovery strengthens. As usual, we'll be publishing the minutes to the FOMC meeting in 3 weeks after it took place. But before we get the minutes, I thought it would be useful for me to offer my own perspectives on our actions last week. In my view, the decision to ease policy further is fully consistent with our dual mandate and policy framework. As I've mentioned before, we have two goals: promote maximum employment and price stability. We therefore seek to minimize how far employment is from its long-run normal level and how far inflation is from our longer-run goal of 2%. Because monetary policy works with a time lag, we base policy not just on where the economy is today, but where we expect it to be in the future. So to do this, we make economic forecasts that are based on data and insights from a broad range of economic models and based in part on our conversations today. We also take into account the balance of risk around our base case outlook. Now, putting all this together, when we looked ahead in the absence of further monetary policy easing, I concluded that growth would remain too subdued over the next several years to make big inroads into the spare capacity that remains following the Great Recession. As a result, from my perspective, unemployment rate would remain unacceptably high with economic risks skewed to the downside. Meanwhile, given the fact there's substantial slack in labor markets and inflation expectations are broadly stable, inflation was likely to remain a bit below our 2% longer-run objective. So in this situation, I concluded that our policy framework means that further monetary policy easing was appropriate, provided that the benefits of using the tools that we had available outweighed the cost. And in my judgment, this standard has been satisfied here. I'm confident that the costs are manageable based on part on the experience we've had using the tools over these past 4 years, and that the benefits substantially exceed the cost, recognizing, of course, that our actions aren't so powerful that all of a sudden we're going to instantly transform the economic outlook. So you might ask, how do our actions support economic activity? Well, buying assets and extending the interest rate guidance puts downward pressure on longer-term interest rates so that they're lower than they would otherwise be for any given economic outlook. That supports the price of assets such as stocks and homes. Buying mortgage-backed securities has an additional effect of narrowing the interest rate spread between these assets and treasuries, which further reduces mortgage rates. Moreover, to the extent that our actions are seen as supporting the recovery and providing some insurance against adverse shocks, that increases confidence in the medium-term outlook, and that makes businesses and households more willing to invest, hire, and spend. If we're successful, long-term treasury yields could actually rise as confidence in a sustainable recovery increases. At the same time, what we would expect is that the expected returns on private assets should rise and risk premiums should decline. This matters because such shifts would provide support to the economic recovery. Now, it's true that some of the channels through which monetary policy affects the economy may be partially impaired at the moment. For example, because of ongoing restrictions in the supply of mortgage credit to consumers with less than perfect credit records, the impact of lower mortgage rates on housing is probably less powerful than normal. While this restraint should slowly ease as home prices stabilize, the difficulties of households with lower credit scores in obtaining mortgage credit does warrant ongoing attention. However, it's worth noting that other channels through which monetary policy affects economic activity are not impaired, including the impact on spending that is generated by rising wealth, declining risk premia, and improving confidence. It's important to recognize that all our tools they're not all powerful. Monetary policy is not a panacea for all that ails our economy. But at the margin, firms facing lower borrowing costs for any given economic outlook will invest and hire more. People who refinance at lower rates or see the value of their homes or 401k pension assets go up will spend more. I believe that a nudge in the right direction will move us closer to a self-reinforcing cycle of more hiring, more spending, more growth, and more investment. This is the type of virtuous circle that we should seek, and one that's consistent with a self-sustaining and improving economy. I believe our last statement, we issue a statement at the end of every FOMC meeting, provides greater clarity about how we intend to use the tools we have to promote our objectives. As Chairman Bernanke said at his press conference, the idea is to make it, quote, more explicit, more transparent to the public, make it more obvious that the Fed will do what's needed to provide the support the economy needs, unquote. In particular, the amount of assets purchases that we undertake will be a function of how the economy evolves. If the economy is weaker, we'll do more. If the economy is stronger and we see a substantial improvement in the outlook for the labor market sooner, we'll end up doing less. From my perspective, linking our purchases more closely to economic outcomes underlines our determination to generate the kind of recovery that will deliver more rapid progress towards maximum employment in the context of price stability. So what does, quote, substantial improvement in the outlook for the labor market, unquote, mean to me? It's a key phrase in the FOMC statement. Note that I will be focusing on the outlook, not just the current state of labor market conditions. In that context, it wouldn't be enough for me just to see an unemployment rate that declines a bit. It would also matter why the unemployment rate is declining and whether that improvement is likely to be sustained in the future. For example, higher payroll employment growth that was not supported by stronger economic growth, or falling unemployment rates that were due mainly to declining participation in the labor market would not likely meet my test. Therefore, to gauge how substantial the improvement in the outlook for the labor market is, I'll be looking at a wide range of indicators, including the unemployment rate, payrolls, the participation rate, the employment to population rate, job finding rates, as well as the growth momentum in the economy. As we approach year end, the maturity extension program, which we're conducting right now, in which we're buying long-dated Treasury securities, that will be coming to an end. And at that time, I'll be taking stock on how we're doing with respect to our employment and inflation goals, and whether it will be appropriate to continue purchasing longer-dated Treasuries when that maturity extension program concludes. I think that this will depend on whether we've seen substantial improvement in the labor market outlook in the interim, and any further evidence about the costs and benefits of continuing with such purchases. In terms of our monetary policy regime, the FOMC statement also noted that the committee expects to maintain a highly accommodative stance of monetary policy for, quote, for a considerable time after the economic recovery strengthens, unquote. This is important because in situations as the one we find ourselves today, when monetary policy is somewhat constrained because we can't push the federal funds rate below zero, one of the most powerful things the central bank can do is provide guidance about how we're likely to behave in the future. In this respect, I'm pleased that we've drawn a sharper distinction between what we expect the economy to look like in a few years' time and how we expect to set policy based on that economic outlook. In particular, when the committee extended the period for which it anticipates keeping the federal funds rate at exceptionally low levels, which I interpret to mean the current range of 0 to 0.25 percentage point, to, quote, at least through mid-2015, unquote, I don't think this was due to greater pessimism about the economic outlook. In fact, if you look at the September summary of economic projections that each of the FOMC members submits, the medium-term growth outlook was actually higher in the September submission than it was in the July projections. In my judgment, combining the statement with the projections, the proper inference in my mind is that we were acting to secure a better outcome, more rapid progress to full employment and price stability. So to sum up, too many people remain without the jobs that they need to support their families and themselves. And while the economic expansion is continuing, we aren't growing fast enough to put back to work many of the idle workers and business facilities that represent part of the productive potential of the economy. Meanwhile, analysis of the inflation outlook suggests that price increases are likely to run close to our 2% objective over coming years. Now, not all the factors that are holding back growth are directly amenable to monetary policy. Our nation's economic challenges cannot be solved and our fortunes restored by the Federal Reserve alone. Others, notably Congress and the White House, will have to step up to the plate. But I am confident the Fed will promote maximum employment and price stability to the greatest extent our tools permit, and we will stay the course. We are setting policy to achieve a stronger recovery in the context of price stability. When that finally materializes, I'll view it as consistent with the result we are trying to achieve, and not a reason to pull back on our policies prematurely. If you're trying to get a car moving that's stuck in the mud, you don't stop pushing the moment the wheels start turning. You keep pushing until the car is rolling and is clearly free. Thank you for your kind attention. I'd be happy to take a few questions.
So just to set the ground rules on the Q&A, we want to get as many questions in as possible. Please refine your question so that it is not a speech from the floor. And I saw John Houston with his hand up, and I'll give him the mic.
Thank you, Paul. John Houston, New York Life Insurance Company. What is the Fed's view on the other side of the equation of the interest rate? That being it as an asset for people that are out of work, companies trying to design products for retirement, people that are out of work that need something. People are liquidating assets that are in the long run going to become, wards of the state. And the second point related to that is, at what point do we get to a position when it's realized that debt has to be paid back, and that is a real concern that business owners have and people that are considering mortgages have? Uncertainty of employment, uncertainty of the business environment. You don't borrow something that can put you into bankruptcy. This isn't our grad school, charts.
All right, let me address the first question first. The question is the level of low interest rates and the burden that places on households and savers and pensions. There's no question that there is a burden there, and I acknowledge it. Our choice is, do we accept that and stay there for a very long period of time, or do we try to push the economy ahead so we can have an earlier economic recovery so we can normalize those short-term rates sooner? You look at the experience of Japan. Japan has had very, very low interest rates for more than a decade. We don't want to go that way. We want to have an economic recovery sooner so we can actually normalize interest rates more quickly, recognizing the fact that there is a burden on savers. Now, in terms of debt burdens, in no way are we encouraging people to go out and take on debts that are excessive. I think people have learned the lessons of the housing boom and bust in that respect. If you actually look at the growth rate of credit outstanding, it's extraordinarily slow right now. In fact, it's just started to turn positive over the last year. The thing that I think that's probably most important in terms of economic recovery is confidence. Confidence that the country's on the right path, confidence that the country will recover. The Federal Reserve can provide a supportive environment from the interest rate and monetary policy perspective, but it's also important that other things take place. For example, addressing the fiscal cliff in an appropriate way in Washington. So, I think we certainly recognize that as I said in my speech, that the Fed monetary policy is not a panacea. And we're certainly being very, very cautious and making sure that we're monitoring whether this period of low interest rates is creating any sort of excesses. We certainly don't want to create another asset bubble, and we look at that very, very carefully in terms of how we conduct our monetary policy decisions.
John Madden, Aquatronics Corporation. I got a couple quick questions. The Maiden Lane III AIG debacle's behind you now, I think. The question is, what I'm concerned about from just a business point of view, I would love to see Congress, through your urging and the Department of Treasury, push to get legislation that will not have this situation work again, that AIG, the tentacles in every aspect of business, why can't they when they do antitrust legislation, say, you know what, if this company goes bust, how will it affect the economy? Because that affects our business, number one. Number two, a quick question. Stimulus money that went to Department of Labor, Education, and Health and Human Services. The federal funding was for the unemployment. So the unemployment went to 99 weeks of UI, of benefits. I was shocked to get a bill, and I'm sure most small businesses, to get that we have to repay the money. So on a suppressed economy like this, 31 years in business, I'm trying to understand these little issues. Okay. Thank you.
Well, second question, I have absolutely no authority over whatsoever. So I think I'm going to focus on the first question. The questioner asked about Maiden Lane III. Maiden Lane III was a special facility that the Federal Reserve established because AIG was having trouble funding their assets, and if they hadn't been able to, if they couldn't fund all their assets, they were probably going to go bankrupt. And so the Federal Reserve bought these assets off AIG's books, and we managed those assets over the next 3+ years, and we successfully completed the sale of those assets just last month. And I'm happy to report that we sold those assets and made a very nice profit for the taxpayer. So we're very happy that we are not managing any of the AIG Maiden Lane III assets again. We're happy that we made a profit for the taxpayer. And the reality is Dodd-Frank means that almost certainly we'll never be able to do anything like that again, and that's a good thing. Your question was really getting at the issue of too big to fail. Should there be institutions in the financial system that are too big to fail? And the answer is absolutely not. And we need to address this in two different ways, and we are addressing it in two different ways. Number one, more capital, more liquidity, so you don't have a situation like AIG, which had an unregulated part of AIG Financial Products, that was going out and writing tremendous amounts of credit guarantees on very complex securities. That's what got AIG in trouble. So more capital and liquidity, more regulation. And the second thing is resolution. So if the institution gets in trouble, there's a way of actually resolving the institution, allowing it to fail without taking down the entire financial system. And we're really working on both those pieces. Now, are we there yet? Absolutely not. But we're in a much better place than we were a few years ago. I mean, if you look at the U.S. banking system today, much more capital, much better quality capital. And the resolution frameworks are being built by the FDIC. And we're working with our foreign colleagues to make sure that we can actually resolve a big multinational corporation if it fails. And finally, on the Dodd-Frank Act, Dodd-Frank also allowed the Financial Stability Oversight Council to designate non-banks as systemically important financial institutions. And so that process is also in train. So if there is a non-bank financial institution that the Financial Stability Oversight Council judges to be systemically significant to the country, in other words, if its failure would really damage the U.S. economy, that will get special scrutiny. So I think, I think we're all, I think Chairman Bernanke once said that the AIG thing was the one thing that made him the most mad about the entire financial crisis. And believe me, being the president of New York Fed in 2009, 2010, when the uproar about AIG was at its highest, I completely can agree with him.
Bill?
President Dudley, can we talk about QE4? It seems like with QE3, you put the pedal to the floor. What other tools does the Fed have if things don't go according to plan?
Well, look, I think I wouldn't be so pessimistic. For starters, I mean, the economy is growing, and it is gradually returning to health, and we just applied another dose of medicine. So I think it's too soon to sort of determine that what happens if the patient relapses. Look, we don't think we're out of ammunition. We can certainly do more in terms of quantitative easing, and I think my interpretation of, as I said, of our Federal Open Market Committee statement was that if the economy needs more medicine, if we see that the economy needs more medicine, we will apply more medicine. So we're not out of ammunition. The tools aren't perfect. It'd be much more better. If the funds rate was at 5%, we were a normal economy, we could just lower the federal funds rate. But I'm very confident that this tools still work.
Bill? Right here. Bill, right here.
Yep.
I'm John Campbell. Bill, is the Fed concerned that the entrepreneurial spirit of America, maybe outside of technology, but just the willingness of individuals to start businesses has been so adversely impacted that will adversely affect job growth over the next 5-10 years?
I don't think I'm at all worried about sort of the entrepreneurial spirit of the country. I think what we're in is a slightly difficult environment, because if you look at the source of startup capital for the very smallest businesses, those that are just trying to get off the ground, three main sources of capital are families and friends, home equity lines, and credit cards. And what's happened is there's been a substantial tightening of standards on credit cards, and the home equity loans that's not a very great business to borrow against, because the value of the homes has gone down. So right now it's really, I think, not a question of entrepreneurial spirit. It's really a question of getting that initial source of financing. When we go around and talk to small businesses, we really find them divided into sort of two very distinct groups. Those that are doing well and have good track records can get credit. They don't really have a big problem getting credit. And in fact, at the margin, I would say credit availability for that group is improving. But those who have impaired credit histories because of the deep recession in 2008, 2009, or are just trying to get going, they have a really great idea, but they're trying to get the capital together to start their business, this is a difficult environment for them. So I think we'll see a recovery over time, but this is definitely a headwind facing the U.S. economy.
Your name, sir? Company, if you have one.
James L. Wixler, Rutgers University. Paul Volcker used to be the president of the New York Fed before he became the chairman of the Federal Reserve System. He is a big proponent that banks should not be allowed to engage in proprietary trading. What are your views on the topic?
Well, it's interesting. I actually can't comment on that. And the reason why I can't comment on that is we're in the process of writing regulations for the Volcker Rule. So when we publish a new regulation, we put it out for comment, and then all the comments come in. We got hundreds and hundreds of comments on the Volcker Rule. We're in the process right now of digesting those comments, and so during that period, we're sort of in the silent period until the new regulation is promulgated. So I'm sorry I can't address that.
Sure. There's one other topic that I think you're very interested in, and that's with regard to financial literacy. Do you have any general comments how you think what the Fed can do to promote, we'll call it, better, wiser spending over the life cycle for most individuals?
Well, look, I think that's financial literacy, I think, is a very big challenge for the country, and one of the main reasons for that is it's not really part of the school curriculum, which is sort of remarkable when you think about how much we're actually putting on people to actually manage their own finances as they go through their life. Especially the very challenging issue of how much do I need to actually save for my retirement. So we're trying to do a number of things to raise awareness about financial literacy issues. We have a video competition that the students participate in every year where they actually create videos trying to raise the level of awareness on financial literacy issues. And I'd love to talk to people, in terms of their ideas, in terms of what we could do more. 'Cause I think this is an enormously challenging issue for the country. When we had defined benefit pension plans and people could sort of count on those for their retirement, you didn't have to be that savvy about financial affairs to have a very, reasonably comfortable retirement. But now that you have 401k and defined contribution plans, I think it's much more challenging for people to actually prepare and manage for their retirement. It's not just that. It's also the whole mortgage thicket. And what happens if you are behind on your mortgage loan? What are your options? What are your opportunities? What can you do? So I think there's a whole bunch of things on financial literacy I think that would be great to pursue that would be good for the nation.
We have room for two more questions. Ed, you're next to last.
All right. Ed Metz, Money Work, Randolph, and former Mayor Randolph. Just a question, and we've been in a low interest rate environment for quite some time, and it appears that we're going to be in a low interest rate for quite some time. We've seen 30 consecutive months of net cash outflows from the stock market. CD rates are not quite what they used to be, so a tremendous amount of money in the bond market. And we're starting to see on the business side insurance companies raising premiums on long-term care policies or lowering benefits on annuities because the money they're investing from the premiums, they're not making the type of money that they used to. So with the extended outlook into 2015 of continued low interest rates, is that a concern?
Well, I think that, I think as I said to the earlier questioner, low interest rates, they have costs as well as benefits. But the point of our policy is to make sure that we don't have that low interest rates for forever. We're trying, the sooner we generate a viable economic recovery, a strong economic recovery that generates employment, that pushes the economy back towards full employment, the earlier we can normalize interest rates, and that's really what we're trying to achieve. So, I certainly accept the premise of the question, which is low interest rates are hard on certain sectors of the economy. But I think it's the policy that we're pursuing, which is pushing hard to generate a strong economic recovery, I think is preferable to a policy of pushing less hard and having less chance of actually having a viable recovery. So that's how I would frame the choice.
Final question.
Hi, Mort O'Shea, Hilltop Community Bank. Do you have a comment on Thomas Hoenig's criticism of the Basel III proposals?
Well, I think I'm not going to debate the FDIC, who's a former colleague of mine. We worked together at the Federal Open Market Committee and the Federal Reserve. I think that Basel III, is really designed for the larger banks, and I think it's a dramatic improvement over what came before it. It significantly raises the required level of capital for large banks, and it significantly improves the quality of the capital. Now, Tom's objection to Basel III is really a more subtle issue. It's not that he's rejecting Basel III and all its attributes. He's concerned about the fact that Basel III allows banks to use models to estimate how much capital they need to set against various classes of the assets. And I think it's important. I think he makes a good point that we do want to make sure that the assets as measured, the risk-weighted adjusted assets as measured, are actually commensurate to the risks that the banks are taking. So this is something that, it's a legitimate subject to continue to investigate. But Basel III, as far as I'm concerned, it's a big advance because we're requiring banks to hold more capital, significantly more capital, sufficient, much higher quality capital, focused on common equity. And that, I think, will make the banking system much more strong and stable. Thank you very much. Thank you.